Which type of stock market investment is right for you? Let's find out, shall we? Alright, so welcome back to the channel. If you're new here, my name is Willis. I'm a chartered accountant. I've been working in the industry for nearly 7 years and studying all things money, accounting and personal finance for the past 9 years. In today's video, we're going to be talking about the main different types of stock market investments that you can make. And just a quick caveat before we get into it, I'm not a financial advisor and I'm not recommending any of the specific investments or investing platforms that I may be discussing throughout this video. And please always remember that when you're investing in anything, your capital could be at risk. So make sure you do your thorough research before you make any investment yourself. So, number one, the most basic and well-known is the common stock. And this is where you simply purchase one or more shares of a company. By purchasing a share in a company, what this means is you're entitled to a certain percentage, based on your shareholding, of the assets of the company in the event that the company is dissolved. It also means that you're entitled to a set percentage of the dividends that company pays out each year. And so you may be wondering, how is the share price determined? Well, share price is determined by the law of supply and demand. And to illustrate this, the supply and demand curve looks a bit like this. And what this is representing is when demand is high, but supply is low, the price of the share will be high. Conversely, when there's excess supply and not much demand, that will drive the price of the share down, because nobody seems to want to buy it. And this is why day trading tends to drive up the prices of companies' shares, because there's lots of buying and selling activity. And so it looks like there's a lot of demand in the marketplace for those shares. Once you own shares in a company, you're then able to sell them on the open market at whatever the prevailing sale price is on that day. This of course assumes that there will be a willing buyer on the other side to purchase them. However, if you've purchased shares in a large company, chances are there's always going to be a willing buyer on the other side to pay the market price for those shares in the event that you want to sell. So there's lots of different types of common stock available to purchase. The first, of course, is domestic stocks. So if you're in the USA, this would be stocks in companies based in the United States. They may, for example, be listed on the NASDAQ stock exchange. Common stocks are generally split into 3 different categories. These categories are 1, large cap stocks. Companies considered to be large cap are companies that have a market cap, which means the total value of their shares in issue, in excess of $10 billion. The second is mid-cap, and mid-cap companies have a total market capitalization of between $2 billion and $10 billion. And the third is small cap, and small cap stocks have a market capitalization of between $300 million and $2 billion. Now let's look at large cap stocks first. Now these companies tend to be the biggest companies in the country and potentially even the world. In the US, these companies will consist of the likes of Amazon, Google, Microsoft, Facebook, Tesla, Apple. And so you can see these large cap stocks are the ones that make up the most well-known household brand names in the world. Large cap stocks are often seen as the safer investment choice because they are such large companies, such well-known brands. And so there is a perceived element of safety in investing in these companies on the basis that people believe they'll continue to grow. Mid-cap stocks, on the other hand, will be sort of your more mid-tier companies. Some of them you may well have heard of, but a lot of them on the list you probably will have never seen before. Now, mid-cap stocks are not quite as safe as large-cap stocks for the same reasoning as we discussed previously. They're just not quite as large as those large-cap stocks, and so there is a perception that they might not be quite as safe because they're not as big or as well established. And then we have the small-cap stocks. Now, most of the companies that make up the small-cap index are probably companies that you and I have probably never heard of, and these are the most risky investments. The reason for this is because these companies are the least well-known companies on the publicly traded stock exchange. These companies likely have the least trading history and also have the least willing sellers and buyers of their shares. This means if you buy a load of shares in a small cap company and want to sell them at short notice because you think the value of those shares is going to go down, you may not even be able to because there may not be another willing buyer in the marketplace to purchase those shares from you. As an investor, you can of course invest in overseas stocks as well, also known as international stocks. So for example, if you're based in the UK, investing in US stocks would be considered investing in an overseas or international stock. Or you can invest in other countries like Japan or Australia. So there's 2 main reasons for investing in common stocks. The first is for capital growth. Capital growth essentially means the value of the underlying asset that you've purchased, in this case the shares, will continue to grow over time. And therefore, when it comes time to sell your investment, the value of that share will have risen sufficiently enough so that you've made a nice profit. And the second reason is for dividend cash flow. And what this means is that every year, sometimes even on a quarterly basis, companies will pay out dividends to all their shareholders. This is how they distribute some of the profits that they've made this year back to their owners. And so when looking to purchase stocks in any company, you need to think about, what am I purchasing the stock for? Is it for capital growth? Is it for dividend cash flow? or is it for a combination of the two? Now let's talk about another type of stock market investment, the ETF or exchange traded fund. An exchange traded fund is a pooled investment security which can be bought and sold like an individual stock on the public exchange. An exchange traded fund is essentially set up to track the underlying value of something. For example, an exchange traded fund could track the underlying value of a specific index, such as the S&P 500. Alternatively, an exchange traded fund could be set up to track the underlying price of a commodity, such as gold or silver. Exchange traded funds are very similar to index funds. The only real difference between an exchange traded fund and an index fund is that an exchange traded fund can be bought and sold on the open exchange like an individual stock, whereas an index fund can only be bought and sold at the end of the day. Exchange traded funds and index funds are generally seen as much safer than purchasing individual stocks. The reason for this is because the ETF or index fund can be set up to track the results of an overall index rather than a specific company. This means that these ETFs or index funds are going to be inherently diversified because they're tracking an entire index which is made up of many different companies than just one individual company itself. This helps to manage the risk that you lose money on your investment, because when tracking an entire index made up of many different companies, a lot of those companies can actually make losses in the year or see declines in their share price. However, the overall index can still see an uplift in its value throughout the year. And this means that your portfolio will have not lost any value. You would have made gains in the year. And just one point to note here around the use of mutual funds. And so a mutual fund can be a type of exchange traded fund. The issue with mutual funds is that they often have very high fees attached to them, which can eat away quite heavily at your returns over the period of investment. I have made a specific video previously detailing the differences between mutual funds and index funds, where we really explore the impact the mutual fund fees can have on your investment over your lifetime. It'll be over here if you want to check it out. So now let's talk about some alternative strategies that we can use in the stock market. First of all, let's talk about shorting stocks. Shorting or short selling a stock is an investment strategy that's used when you believe the price of the underlying share is overvalued and it's therefore likely to fall. And the way this works logistically is you essentially borrow those shares upfront and sell them to the open market first. Then, when the share price falls, you buy that security back again at a lower price, and essentially then just pocket the difference. And so when most people think about their investments in the stock market, they always want them to increase. If you're using short selling, you actually want the share price to fall. However, when short selling, we need to be extremely careful. And the reason for this is because the downside risk is virtually unlimited. In order to explain this further, let's jump over to the whiteboard. Okay, so let's use an example here to demonstrate how upside and downside risk work. If you purchased an individual stock for $100, this means your downside risk would be limited to this section here. However, your upside potential would be virtually unlimited. And what this is showing here is, if you made an investment at $100 per share, the maximum you can possibly lose is that $100. However, if you short sold a stock and the stock went up in value substantially, your losses could be much higher. Let's have a look. Okay, so in this example, let's say we short sold a stock for $100 because we believe the value of that stock is about to go down. What this means is our upside potential is limited to $100 and this section of the graph. However, if we were wrong in our prediction and the value of that stock increases substantially, our losses are potentially infinite. And the reason for this is because the value of a stock can never fall negative. And so if you purchase the stock with the intention to realize a capital gain, the maximum you can ever lose is the total amount you invested. However, when you short sell, you're predicting the value of that individual stock to decline, and therefore you make a loss when the value of the share actually goes up. And so if the value of the share continues to go up and up and up, and you don't close out your short, your losses continue to go up and up and up as well. So just a word of warning to be extremely careful when using short selling. And the second alternative strategy that we're going to discuss today is the use of stock options. Now, stock options in itself could be a whole nother video, but we'll touch on the basics here. By buying or selling a stock option, this essentially gives you the right, but not the obligation, to either buy or sell an underlying security, being a share in most cases. There are two main types of options. These are call options and put options. When you buy a call option, this gives you the right, but again, not the obligation, to buy the underlying share at a fixed price agreed upon at the time of the purchase of the option on a future date. And call options are useful when you believe the underlying share price is going to increase in value very soon. You may wish to lock in place the purchase price today on the basis that the purchase price next week might be significantly higher. And what this option allows you to do is have the option to purchase that share next week at the price it is today. And then when you exercise the option and actually buy the share next week at today's price, you can instantly sell the share at the prevailing sale price next week. However, let's say the share price fell against your expectations. Well, you haven't purchased the underlying share, you've only purchased an option that gives you the right, but not the obligation, to buy that share. And so what you do in this scenario is let that option elapse and not exercise it. And therefore, your only loss on this transaction is what's called the option premium, which is essentially just a fee you paid to buy the option in the first place. Put options are essentially the opposite to call options. Buying a put option gives you the right, but again, not the obligation, to sell the underlying share at an agreed upon price today at a date in the future. So you may own some shares where you believe the share price is going to fall in the near future, but you're not completely sure. You may purchase a put option that allows you to sell those shares at an agreed upon price today, sometime in the future. And so the ultimate outcome of this is hopefully if those shares do fall in value, you're able to sell them at a higher price than the prevailing market date price, protecting your loss. And again, if your prediction is incorrect, you simply don't exercise the option, you let it elapse, and then the only loss you've made is the fee that you paid, known as the option premium, to purchase that option in the first place. I hope you enjoyed today's video, and if you got some value out of it, please don't forget to drop a like on the video and subscribe to the channel. See you next time.